intervening private access. And we're going to go over right now a few things. I want to give you just sort of an overview and let you know how the workshop is going to progress, what to expect. So what we do is we start off from like an aerial view, or I should say actually a satellite view. We start from a view from space, if you will, with a really wide perspective and give you a lot of overall perspective on the strategy and also on how we trade the market. And then we start zooming in. As the days go on and as the hours go on, we go to an aerial view, and then we get to an overhead view, and then we zoom down to like a microscopic view, a very, very precise, getting right to the day that we buy and sell. And we also work, if you were to look at, say, a chart from left to right. So we start with the beginning of the trend, and then as that trend progresses, we start talking about the chart patterns, and we work to the right side to the buy point until that stock goes up, and then we get to the selling portion, and then we build in the fundamentals underneath, and then talk about risk management. So that's sort of how it progresses, and it also gets it goes from being basic to much more complex. Each day it gets more and more complex. So we'll start off with some basics, and then it gets more and more complex as the workshop progresses.
And Mark, maybe let me chime in here with just a few things that I think people should keep in mind is that, you know, throughout this whole workshop, we're laying all this out for you. There's no secrets. There's nothing that we're hiding. These are things that we've used throughout our careers that we've learned along the way. And there is so much information out there on enacting this. I mean, when I started at O'Neill in 1982, he hadn't written the book. The book didn't come out for years later. And it took me about 3 years to really get the hang of all this. And what you've got to do with this, with all this material that you're about to go through, is you're going to have to take this and study it, and constantly studying it and work on this, because it's going to take some time. With me, it took it about 2.5 years before I really pieced it all together, and I was right in there at working for William O'Neill. And I know, Mark, you've said it's taken you 5 years to really make a lot of mistakes and then put it all together to start doing well. So remember, we lay it all out, study all this material, and then just be patient. If you stay with it, it'll all come together, and you'll get some very, very good gains.
Yeah, and this particular program, I think, is the fastest track to getting you to having everything that you need. But again, even if it shortens it to a year or two, you can't force experience. It takes time to get the experience. And while it took me a long time, it was about 6 years before I started getting profitable. We didn't have what we have today. This access to this information. This is really it's a great time to be a stock trader. It's a great time to be a lot of things, because you can learn from the people who actually, write the songs if you're a musician and so forth. I mean, online is an amazing tool, and of course we're using it here in a way that we haven't in many years. Lots of people are now doctors. Everybody's going online, right? So we're going to bring you this information, and it's going to take time, though. And we've heard people say that the Master Trader program is like drinking from a fire hose. Now, one of the good things about the online version here is that we're going to space it out over a number of days, that we're adding more days and less data just thrown at you in one day. Dave can attest, and he's always saying, please, let's shorten it a little bit, because we'll go for 10 hours a day. It's a grueling days. And and there's a lot of information. So we're going to try to space it out a little more and not overwhelm you as much, and be able to have you digest it a little bit better. So I think that's one of the benefits of online. So we'll start off giving you some perspective here, okay? And specific entry point analysis is my strategy, if you will. It's certainly my entry techniques that I've used for many years successfully, and the real key to professional trading and to trading like someone like myself or David, how we trade, is that we're looking to take number one, very minimal risk relative to our reward. We're looking to capture relatively large gains to that risk. So managing that risk reward relationship is really the key. And then being able to do that and do it as often as possible and to turn over your edge maximizes your compounding. And that's how you get bigger returns with less risk, is to be able to turn that edge over as much as possible. And from there, it's selection. It's a selection process, it's trade execution and position management. And we're going to go through all of this over the next several days. Now, there's 5 areas that we're going to cover, and we're going to cover them in very much detail. But there's 5 broad areas. One is categories and catalysts. The second is the study of price and volume. We're going to look at technical analysis and study the price and volume action, company fundamentals, and entry and exit points. That's going to pretty much boil down the Master Trader program to everything that we're looking at. But like I said, it's going to be very detailed, so it's in a lot more topics than that. But those are the 5 key areas. Now, there's 6 categories that I categorize companies in. One is the market leader, 2, the top competitor, the institutional favorite, the turnaround situation, cyclicals, and laggards. That's how I classify a stock. I want to sort of, when I see a stock, a company, I look at it, and the first thing I do is I say, okay, what category would I put this in? Now, I generally focus on the top 4. The market leader, the top competitor, the institutional favorite, and the turnaround situation. And David does basically the same. He's looking mainly at, and we're both mainly looking for the market leaders, those top competitors, and occasionally the institutional favorites and some turnaround situations. The cyclicals, occasionally we're looking at cyclicals, but they're not growth stocks, and they don't have those secular moves, and they have a little bit different way that you have to treat them. And laggards, of course, those are the ones that we generally stay away from, and sometimes even short. Now, I want to give you a sort of a few of each of these 4 that we look at. The market leader, this is the one that you really want to focus on and concentrate on. These are usually first to emerge in a bull market. All right. They're going to almost always look expensive. They have usually a relatively high PE. They'll be traded near their 52-week high. They're sometimes very hard for people to buy because they appear expensive. They'll lead in RS, relative strength ranking, EPS ranking, earnings per share, sales margins. They'll usually have the stronger of those. And many of them are in the small and mid cap area. And a lot of times they're names that you've never heard of before. And
and I would say in most cases, they're names that you've never heard of. But one thing I know it mentions many are small and mid-cap names. It seems like more and more are companies. We used to look at market caps of under $1 billion would be small, or under 500 million. Now you have these IPOs that are coming out with very, very high capitalizations that turn out to be some big moves. But the other thing I would add when you're looking at all these different categories is that I would say 80% or more of your buying should be in the market leader area, and then another 10%, or maybe you split those 2 up a little bit. But most of your buying is in those top 2 groups, and then institutional favorites, not so much, and then turnaround situations, maybe 5 or 10% at the most. Is at least the way I would be weighting those in my portfolio.
Yeah, so I also try to concentrate my buys in the market leaders and the top competitors. And again, the top competitor, all right, moving from the market leader to the top competitor, the top competitor is the number 2 or 3 companies in an industry. And sometimes you can have a top competitor leapfrog the leader. So for instance, I'll give you an example, Home Depot and Lowe's. So at one time, Home Depot was doing much better than Lowe's, and then Home Depot slipped and Lowe's sort of moved into their position and did well for a while. They've sort of flipped back and forth. But if I were to ask you, what's the number 1, cola, what would you think? Probably maybe Coca-Cola, right? Or Pepsi. If I said what's number 2, same thing. You'd say Coca-Cola or Pepsi. So if I said, no, what's number 3? Maybe, RC Cola, right? How about number 4? See, so you're not so quick probably to come up with a name. So as you go down the list, as you get away from that 1, 2, 3 spot, you start getting away from the real leaders in any industry. Even like, say, coffee, maybe Dunkin' Donuts and Starbucks. You might think of a few names, but as it gets away from those top 3 or 4 names, now it gets into names that, that aren't the leaders. That's sort of the way it works with the stock market, particularly in most groups, maybe not like in the semiconductor group because there's so many companies, but in many of these groups. And these companies sometimes will move together in a group. So you might get, the top 2 or 3 companies that do really well stock wise, even though the top competitor maybe has an inferior track record compared to the market leader. But the leader usually it leads in performance as far as the gain that you'll make in the stock and the underlying fundamentals. Now, the institutional favorite, these are companies that at one time usually were market leaders. Like, for instance, an IBM or an Apple now and a Google. These are big companies, very large companies that the institutions love to own. They're liquid, mega cap. But I can tell you, when I was buying them originally, Amazon in 1997, Yahoo 1997, Google, in the early 2000s, nobody knew these companies, and they were small companies. They were market leaders. They were relatively small, usually, mid-cap names. And now they're big institutional favorites that everybody knows. Now, by the time you get to that institutional favorite name tag, if you will, or it's, it's officially a growth stock, officially a quality company, right? You would think of Apple as a quality company, sort of a safe holding, right? Well, there are no safe stocks, first of all, but these names are liquid and they're generally large cap and they're very widely followed. And most of the really big stock move is behind them. Like, you're not going to get Amazon to make a move like it made in the last 10 or 20 years in the next 10 or 20 years. That's just not going to happen. So you're going to have to look for some names that maybe you're not so familiar with, and that might be the next Amazon. So bear markets can provide opportunities for these names when they're down. But again, we would focus more on the leading stock area. And then the turnaround situation, just to round this off, and to wrap it up, now, you might have a company that fell on hard times, and now they've got a new CEO. They have some recovering fundamentals. They've changed their business plan or improved and refocused their business strategy, rid losing operations. They maybe cut costs and streamlined. And they're going against easy comps, and they usually have their margin deterioration causes them to fall on hard times, and their margins come back. That was actually the story behind Apple. So these have to be treated a little bit differently. So the reason why we're bringing this up is because we're going to show you how to treat each of them and the caveats that you might have to understand to know how to treat these various categories. Now,
wait, Mark, I just would add too that and this is something that you I think you mentioned, but I think it should emphasize is that most of these stocks that are in these categories, they are found in groups that are some of the strongest groups in the market. And Market Smith has about 198 groups. They should be in the top 25% of all groups. So the top 50 groups are where you're probably going to find most of these stocks.
Yeah, particularly at the start of a bull market. If you had a bear market and you're just starting a new up leg, you want to really start to concentrate in the very best stocks and the very best groups. And like David said, you'll see that there will be group moves. This has happened in every cycle. Usually a bull market is led by 3, 4, 5 groups. And those will be the leading stocks will be in those leading groups. Well, now, a market leader, here's a perfect example of a stock that was not only a market leader, but was in a very strong group at the time. And I'm sure, Dave, that you remember Amgen back in the 1990s. This was a stock that I was buying. O'Neill was buying this name. Dave was probably buying this name back then. But I want you to take a look. The market's down 35% and just coming off of its lows, just starting to come off the lows there. And you can see Amgen is moving into new highs. Now, I want to point out, you can see the stock price. It's adjusted for stock splits, or it wasn't trading at $2. I don't trade $2 stocks, and David doesn't either. We like the stocks to be in at least double digits. At the time, the stock price was much higher, but these charts have been adjusted. So as you go through the workshop, if you see charts at 5 cents or $1, that's not the correct price, okay? This is where I'm buying. I'm buying right here as the stock is moving into new high ground, coming out of this base. And this stock goes up from this point, goes up 175%. in a relatively short period of time. And you can see how many of you got to ask yourself, how many of you would buy a stock that is this high and coming when the market is down 35%. And I could tell you right now, if you remember, Dave, back in 1990, everybody was calling for a 1970 style bear market. It was just oil prices were going up, and we were at the brink of war. The news was just horrible. It was very, very tough to buy here, but I saw a lot of stocks in the healthcare area and technology were coming out of bases and breaking out, and these were the market leaders. This is why they're hard to spot and buy, is because they look expensive, and they usually emerge at a time where you're coming off of a bear market low. It's very difficult to buy at that point.
Yeah, and your frame of mind after a bear market's been going on for months, and this is this is almost, it looks like a year at least on the NASDAQ at this point, that it was going down. You get in such a negative frame of mind because you go, when's the market going to turn? When is it going to turn? And you start seeing this. It's so hard to hit the buy button on something that's breaking into new high ground when the market's only been down and you've only probably been chopped up for months. But that's where you really have to concentrate on relative strength line. What stocks have that going into new high grounds as the market is underperforming.
Right. Now, if you take a look at Amgen in hindsight and you see what happened from that point on, you can see the stock was actually very cheap at that price that looked so high. A big move here that ensued over the next year or so. And again, this stock went up 360% in 26 months. And that's about average for a move in a leading stock. The average is about a year and a half. Sometimes it's 2 years, maybe a little more. But this is a typical move of a leading stock emerging. Now, taking a look at Lumber Liquidators, this was another name. And again, this is a perfect example that Lumber Liquidators didn't have a big lifespan. They actually got into a bunch of trouble after this, and the stock topped. But this is how I wanted to point out that this is how I get leverage on the market. Some people talk about, using margin. I get leverage on the market by buying the best merchandise that is powerful and can make a much bigger move than the market. So you can see here, the market moves up 33% during a time where this market leader moves up 240%. And just like with the Amgen, where the market moved up from there, but Amgen moved up multiples of the market. So this is how you get your leverage, and you really get those nice big returns, is that you're moving in the areas that are very powerful and can make those type of moves. And you can see here again how it's resisting the market, moving into new high ground, showing a lot of strength before it makes that move. A stock that is looked like that recently is a DocuSign. So take a look here at DocuSign, and we're going to compare. We're going to get into this a little later as far as comparing stocks to the overall market and taking a look at when you should be purchasing them relative to the general market. But I want to just point out that if you look at the market here with this big waterfall that we had, and you broke below the 200-day moving average, and you can see DocuSign just came down to an uptrending 200-day moving average, and right off the lows, just several days off the lows, or not even a few weeks off the lows, we're in new high ground on DocuSign. This stock's just screaming that it wants to go higher, and then over the subsequent months, the NASDAQ goes up 36%, and DocuSign goes up 120% during that same period. You see, that's how you get that leverage. Very similar to the Lumber Liquidator situation. Now, top competitor. All right, here's a great illustration, and I've got a few precedents for you to take a look at a market leader and a top competitor. So Netflix at one time was a competitor of Blockbuster, and they came onto the scene with this digital format. And Blockbuster, if some of you are old enough to remember this, had tapes that you would go and you would rent and take them home and then bring them back. And as a matter of fact, I remember in the back of Blockbuster, you'd go there and they had a little room, and there was just somebody back there just rewinding tapes all day. It was, of course, that's the way that we watched movies then. And Netflix really didn't come up to speed for a while. And Blockbuster did not buy into that technology and that future where that industry was going, and Netflix really saw, the future in this industry. Now, here's the interesting thing. You see right here, Netflix goes IPO, and if you take a look, it was almost to the day that Blockbuster topped. Netflix came on the scene, and it's like the stock knew that there was this formidable competition, and the stock tops. But watch this. It takes from 2002 all the way until 2010, 11 before Blockbuster stock is virtually vaporized, and they were basically going into bankruptcy here. And once the competition, the market leader is gone and vaporized, look what happens. Netflix breaks out, and it's off to the races. You see, and right almost to the day, I think it was maybe 4 or 9 days, I can't remember. I think it was 9 days to the day that the IPO from Netflix went public, that Blockbuster topped. And then I was actually buying Netflix in 2010, right here, as it was coming out of, you can't see it, that's a pretty large base, but it was coming out of that base. And then since then, of course, it's gone even much higher.
Yeah, and Mark, on Blockbuster, I remember, and I was one of the first subscribers to Netflix in terms of, a lot of people probably don't even know that they used to send their DVDs in the mail. And Blockbuster, you had to go to the store, and Blockbuster made, I think, $40 million one year just off of late fees. You could only keep it out for just a couple of days, and you had to get back by the time the store closed at 10 o'clock, and you're rushing to get there, where with Netflix, with those DVDs, you could hold them as long as you wanted to. And so the concept, it totally flipped the whole industry on its head. And I don't think Netflix went online until I think a number of years. I think it was, probably 05, 06, maybe even longer before it actually started to be downloaded. And the DVDs have now have almost disappeared.
That's right. It was still hard copy back then, where you actually, that's right, you got them in the mail, and it was a very different model, and that's a disruption. That's what you're looking for, a disruption, disruptors, and disrupting an industry and a totally new category, which we'll talk about in just a second. We'll take a look at the biggest disruptor probably in the last 100 years. But let's take a look here. I want to show you another precedent that's very interesting, very similar to the Blockbuster Netflix story, is the Michael Kors versus Coach. And at the time, Coach was sort of the only game in town when it came to that sort of high-end pocketbook, and my wife is much better at this than me, but when it comes to this fashion stuff. But I remember, Coach they were in that maybe $300 to $600 range, and it wasn't the expensive bag like a Louis Vuitton, and it wasn't a cheap bag, but a really high quality bag. They kind of dominated that industry. There really wasn't much competition there. And then Michael Kors came along, and take a look again. Look at the IPO, and just shortly after, Coach tops. And during this same period, which is a few years, right? Michael Kors goes up 329%, and Coach goes down 56%. I mean, they're literally completely opposite directions. This stock tops and gets cut in half, while Michael Kors just has a great run, and that's the new boy coming into town. Whether it's a top competitor, it certainly wasn't the market leader at the time because they just went IPO, but they came on the scene, and they took over that top spot. So that's looking at top competitors. Now, disruption. We're talking about disruption. Amazon has got to be one of the biggest disruptors in the history of the stock market, because they didn't just come in and disrupt one area. They started off that way. They came in and disrupted the book the book business, which we virtually don't even have. There's not even a bookstore anymore. Almost, I think maybe Barnes and Noble. There's a few left over. Books A Million. Very few bookstores. Although I heard now that Amazon actually opened a bookstore after they vaporized everybody. They're opening bookstores now. I heard it was in Washington and D.C. But not only once they took that area by storm, they moved into almost every retail area. And now, Sears and all the big box companies, we pretty much buy, everything on Amazon now. So this is a total disruption of across many industries. And again, this is where a competitor comes in, has a new model, a better way, a totally new category, and can be a competitor that turns into a leader and dominates an entire industry. Let's look at the institutional favorite. So the institutional favorite is a stock that has been a market leader to the point where it's made a huge move. It's been going for a long period of time and has grabbed the attention of virtually everybody. Cisco was a perfect example. Cisco had 16 quarters of triple-digit earnings, was one of the biggest winning stocks in a long time. I believe it went up 70, 80,000% from the IPO. I actually bought it. The funny part is I actually bought Cisco off the IPO base and traded it for 5 points. And then it went on to go up 70,000%. Fortunately, I traded many names along that way and was able to make over 100,000% during that period by trading in and out of a lot of names and swing trading. But this one stock made a huge move. And then by the time everybody loved it, and Qualcomm and many of these names that were the high flyers of the 1990s, that's when it becomes a late stage, crowded trade. All the institutions are in, and now there's just tons of supply. And now you can see the stock tops with the market and then moves sideways for the better part of 16, 17 years up until just recently, where I'm not even sure if it's in new high ground yet. It might even be 20 years. Another one to look at would be Qualcomm, which I just mentioned. Again, here's where it's a market leader, turns into an institutional favorite, and then look, 21 years later before it gets back to even. But you see, you can buy some of these off of bear market lows. Once they become that quality leader, you might be able to buy them coming off of bear market lows, and you can get a move out of them. But you can see nothing compared to this meteoric rise that it had when it was a market leader.
And Mark, you can throw a few more stocks. I mean, Microsoft was the same thing. It topped out in 2000 and didn't start acting well until 2016. So it was also dead money for 16 years. And that's, I think, showing these examples, it's a great point to make that there's a big difference between a great stock and a quality company. I mean, you can buy a blue chip stock and not make money, but you have to have the two have to go together. You want a great stock and a great company. Just because it's blue chip and everybody knows about it might not make it a great stock. And so great stock along with great company is what you want to be invested in.
That's right. So by the time you believe it's such a great company, might be the kiss of death. It might be that towards the end of a big move. And again, one of the names that everybody would think of when you start thinking of a big company, $2 trillion company, Apple. And at one time, Apple again was a company that was very unloved, especially prior to, or even by the time we came out with the iPod and iTunes and even the iPhone. You can see that all these technologies were out way before the stock price and the income ever really started growing. The iPhone was out, 2007. iTunes was in 2003 or so, and iPod was released back there. And Steve Jobs had just come back. Actually, Barron's did a story on me, and I said I liked Apple, and my punchline was Steve Jobs is back on the job. That was one of my reasons, because of course, Steve Jobs was an incredible visionary and took that company to an amazing history. Now, again, Apple is known now as the great turnaround, because this was a turnaround situation. You would never think of Apple as a turnaround situation, right? But it was literally almost completely out of business right over in this period right here. And then Jobs came back and the whole thing got turned around. And we're going to look at that later on, is some of the specifics of what happened with Apple and how it was turned around with profit margins and so forth. But real quick, just want to touch upon cyclical stocks, because cyclical stocks have an inverse PE cycle, an inverse earnings cycle. What happens is, because they move with the economy and they don't make these secular moves, is that it's sort of just the opposite of what you would see with a growth stock. With a growth stock, you want the big earnings, and you with a cyclical stock, it's just the opposite. A lot of times the news is the worst and the earnings are down and the PE is massively high because they're reporting losses, and that's at the bottom of a cyclical swing. And at the top, you'll see earnings look great. The PE is actually low. It looks like it's a better value, and the news is all rosy, and that's when you should be selling. So you sort of have to think about it a little bit differently with cyclical stocks, and of course they're cyclical. They don't make the secular moves, multi-year moves. So I generally stay away from them. If there's a move, maybe gold's moving up, you might gold stocks should get some leverage from things like that. But the paper, the steel stocks, the precious metal stocks, these are all your cyclical areas. Now, real quick, I always just show this one play that I made that was a commodity play, and again, it's a cyclical type play. Back in the 2004, 2005, copper prices had soared, and I noticed that Encore Wire was setting up in a base, and I did a little research on it and found out that they had stockpiled a whole bunch of copper that they had bought prior to copper prices soaring. So, reasoning says that if you locked in that price and now the prices are much higher, you can pass that on to your customers, and that would widen their margins. And that's exactly what happened. Their profit margins exploded, and the stock made a big gain. I made a double on the stock at that time. But that was like a sort of a special situation commodity play, one way you can play cyclicals. I want to go back. Go ahead. I'm sorry.
I was going to just add with the cyclicals, you usually want to see two very, very large quarters. And I think we get to that later, but you do want to see some kind of turn in the earnings to go along with the performance of the stock price.
Yeah, same thing with turnaround situations, and we are going to go over that later on in fundamentals. I want to roll back for a minute, and I want to talk about sort of my very first investment model, if you will, or criteria. When I started off, my very first criteria, and just because I want to show you the thinking about thinking of probabilities and stacking as many probabilities as you can in your favor, and how I started to build the strategy that I now employ. I started off by building a strategy that I call the 95% club, or looking for stocks that fell into the 95% club. And what that meant was I wanted to go and look at what were the biggest winning stocks? What were the characteristics that they had? This was the O'Neill study, and going back to the Richard Love study in the 60s and 70s, and then of course O'Neill in the 80s and 90s, and then in the 90s and 2000, I furthered that study, and sort of just on that body of work, we just kept building on that body of work, looking for the common characteristics of big winners. And none of us from the 1960s all the way till when I was getting involved in the 1990s, we didn't find much new, much different. It was pretty much the same characteristics. The companies got a little bit bigger over time. But what I found was 99% of these big winners were trading above their 200-day moving average when they made this big gain. 96% made that gain above their 50-day moving average. 95% of them had relatively small floats. If you went back to 1970, the float was 3 million to 5 million shares outstanding. If you moved forward a little bit into 1980, you moved up to 20 million, and it's 25 million. And then, 10 years later, it was about 25, 30 million. So just a little bit, the companies got a little bit larger, but 95% of them showed some sort of earnings acceleration in the prior quarters. And 96% of them came off of market corrections. They started their move from market corrections. So market corrections are good. If you're looking for these leading stocks, you want a market correction, and that's where you start looking for these stocks. And 95% of them had a catalyst. They had some type of positive catalyst, some kind of change, a new product, service, or a change in their industry for the better. So what I decided was, I want to be in the 95% club, not the 5% club, right? So if I start looking at stocks that don't have these characteristics, I'm in the 5% club. I've got a 5% probability of finding a big winner because these are the characteristics of big winners. Adding to that, looking at these studies, 70% had earnings on the table already of 20% or greater in the most recent quarter. And the real eye opener is 80% of the biggest winning stocks. If you go all the way back to the early 1900s, we went all the way back to the 1800s. O'Neill went back to the 1800s. We looked at stocks going back to the original moves from companies like GE in the turn of the century, and 80% of them were IPOs, new companies on the market within the previous 8 to 10 years. So again, it's not these companies that have been around for 30, 40, 50 years. It's the relatively newer companies. And then again, why do I focus and why do we focus on these areas, these categories? Well, again, if we look at the groups that produce the biggest amount of winners, you're not going to see cyclicals in there. You don't see steel stocks. You don't see papers. It was consumer retail, technology, computer-related and peripherals, drugs, medical, biotech, and leisure and entertainment. Those 4 areas accounted for 70% of the biggest winners. And that's very eye-opening, especially when, as Dave just pointed out, there's 198 subgroups that IBD follows, and sectors. There's a good handful of sectors, but these are the areas where the big winners were being produced. And of course, as technology changes, you'll see some changes here. But I put this together, and I do this each year, that we do this just to make a point. It may not be exactly the way things progressed here, but it's really just to make a point. And this is where what we call the spin-off effect, or sometimes it's been referred to as the cousin effect, or the main thing to realize is that each industry not only builds on the previous industry, but creates conditions for completely new categories. Like, for instance, Netflix, completely new category. Amazon, completely new category. Microsoft at the time, Windows, completely new category, completely new technology, changed everything. The internet, completely new technology, totally new category, breakthrough technologies, disruption, okay? So let's look at how that looks. So we go back into the 70s and 80s. We look at the mainframe computing. Back then computers were gigantic. You have to fill your entire house with computers to do what you can do on a watch right now, right? Then local area networking, tying computers together. Software, at one time, if you remember, we had computers and used to have that little blinking light, MS-DOS, and we couldn't do much with them because there wasn't a whole lot of software for these computers. So now software was something that became a natural progression from the computer. Routers, internet infrastructure. Now we got online, and we had a lot of data, storing the data management. In the 1990s, personal computing exploded. Dell computer, laptops. From there, we had online services like AOL. People started going online. If you remember going online with AOL, if you're old enough to remember, where you logged on and it went beep for like about 40 minutes before you could log on. It was archaic, but that was the early stages. So then, we started putting things over the internet and online, and we needed bandwidth, right? That was the big problem, is that you had, you couldn't stream videos and do things that we can do today because there wasn't enough bandwidth. And you had companies like Broadcom. Then we had internet search. It started with Yahoo, but Yahoo kind of slipped up and got into some other areas, and Google came in, and that's a perfect example of a top competitor. Google came in and took over internet search. Then now we got everybody online, right? And they're all talking to each other, and it's sort of like, going to a bar and everybody's going home having unprotected sex. We need to put a condom on the computer now, right? We have security, software security. We have to protect everybody, which is even bigger than ever today. Then we move things off the computer, right? The cloud. Now we move them to the cloud. They're off the computer. Completely new category, right? So, social media, networking. That's what we're doing. That's what this is all created. Twitter, completely new category. And now what's next? Artificial intelligence. We went from mainframe computing to desktop to laptop to tablet to smartphone. Just get smaller and smaller and smaller and more powerful, and then areas that you could never even think of. I mean, could you ever think of doing the things that we do today, 20, 30 years ago? No. I maybe, I don't know, Steve Jobs and Bill Gates probably envisioned this stuff. So,
and then Mark, let me add a couple more to this. A lot of these that you've mentioned are new categories and spin-offs from other technology. A lot of these are all technology companies, but just think of a few other ones that it's a totally new category. In the soft drinks area, Monster Beverage has been and was one of the biggest stocks of all time in the last 20 years. And they invented a whole new category of, high octane or, lots of caffeine, lots of sugar, and, with their Monster beverages. That's one add-on. Another one is, how about in cars? Tesla has revolutionized and almost really invented a whole new category of cars that only use batteries. And you can go on with retailers. That's a whole new category like Costco and big box retailers like a Home Depot or a Best Buy. But you always have to be looking for those new categories, those new, as you mentioned, disruptors. And even in some of the most mundane industries, someone can come along and totally change it.
Home Depot is a perfect example. When Home Depot came out, and big box retailing was a completely new category, and nobody ever realized what it was going to do, what it was going to create, and what it was going to destroy. The hardware stores were everywhere at one time, and now you could barely find one anywhere. They just wiped the entire industry out of hardware stores, very similar to how Amazon wiped out the bookstores. So again, these are just natural progressions, and it'll continue. You have to look for what's the next technology, and it might be something that may not even make sense to you. And you have to trust the stock breaking out into new highs, coming out of a base. And some of the techniques that we're going to show you will lead you to these breakthroughs, even when you might not even know what those what the future holds and how big it's actually going to be. Real quick, we're going to wrap up here on this just general overview to start off with, and looking at categories and catalysts. The best candidates that you're going to find are going to be growth related, accelerating earnings and revenues, explosive market positions, things that are sustainable, like I said, not cyclical, trends that could be secular, and scalable business models, and disruptors, disrupting industries, totally new categories and totally new technologies. The worst candidates are going to be highly capital intensive, limited pricing power, heavily regulated. Airlines are a perfect example. Not that there aren't periods of time where airlines could be good investments, but when you look at these areas that take a lot of capital, you don't have much pricing power. There's tons of regulation. Margins are under pressure because maybe there's a lot of heavy competition. If their position is eroding in the industry to some type of new technology, these are the areas that you want to stay away from. Those are your worst candidates. So we're going to get very specific, but as we move on, but we have some more overview, which we're going to come back. We're taking a break right now. And we're going to come back with some more from that satellite view. And then we're going to come down to an aerial view and keep zooming until we get, of course, over the coming days, where we get to some very specific buy and sell points and get to some really exciting topics.
And Mark, if I could add on this, when you look at these best candidates, you are really you're looking at a market of, let's say, 3, 4, 5,000 stocks, and you want to be finding the best stocks that have these characteristics. So you're taking the whole market and you're bringing it down to 100 stocks, or maybe even 50 stocks, or even less than that. And when I worked for William O'Neill, he would take the entire market and really narrow it down to just a couple of stocks where he would really concentrate in. But that's what you want to do. You want to be very critical and throw out a lot of stocks that don't have these types of characteristics, and narrow down and zoom in on the best that have these different characteristics.
Yep. And we're going to show you exactly how to do that. And we'll be back soon. And we're going to take a break right now. Okay.